With just 3.5 weeks to go before the Bank of Canada's next rate announcement, a lot sure has happened since the last one. To begin with, the US Fed in September, about a week after ours, they announced its first rate cut of this cycle, and it was an oversized one to start things off. And then again, in today's US inflation report, American markets are now predicting another 50-point cut from the US Fed at their next rate announcement date, which will be in November. Here in Canada, we're starting to see more and more economists agree and suggest that Canada is now poised for some oversized rate drops ourselves. Capital Economics this week suggested that both the October 23rd and the December 11th rate announcements will likely be 0.5% rate drop, followed by additional 0.25% drops in 2025. With the battle against inflation all but won, with weak GDP growth and the recent drop by the US Fed, the Bank of Canada may be forced into taking more aggressive action. The bank itself admitted that they'll be willing to cut rates even more quickly if GDP growth fails to pick up. And GDP growth has been trailing our record population growth. GDP growth here in Canada per capita has been negative for over a year. And while we're not officially or technically in recession because the overall economy is growing, on a per person basis, we are absolutely in a recession, and we have been now for a year and a half, and we're absolutely feeling it. Look here at household consumption. It shows starting early in COVID, as our immigration really picked up, overall spending by household has risen, or overall household spending has risen steadily, but per person, it's been dropping for about 2 years now. Capital Economics is suggesting a full 2% drop by the end of 2025. The bank's policy rate will settle in somewhere around 2.25%, which is only 0.5% higher than what it was before COVID. Take a look there on those two circles. That's really, really close to what it was, just a little bit higher. The market is already pricing in that this is what the rate drop is going to get to. Capital Economics is suggesting it might be just a little bit faster than the market is suggesting. Now, if we take a look at inflation, headline inflation has returned back to its target of 2-ish%, with the most recent headline inflation number in August coming in right at 2%. Inflation is expected to remain in this area, with CPI trim also falling down to 2% in the second half of 2025. And now the main reason that CPI inflation is even likely to stay above 2% instead of falling below it is because over the coming years, rent and mortgage interest cost inflation is still expected to remain historically elevated. And these two items actually make up 13% of the CPI basket. Now, to break it down further, rent inflation should be turning a corner here as the government's new plan to reduce immigration has slowed population growth, and in turn, it has slowed demand for rental housing. But rent inflation is still likely to remain higher than the pre-pandemic levels as the average rents continue to catch up, especially in some of the other markets where there are rent controls. They have to wait for new tenants to move in. And so those rents will be increasing as there's tenant turnover. Now, high inventories, high interest rates, slow economic growth are all going to be putting downward pressure on prices of durable goods in the short term as economic growth accelerates next year. Goods price inflation should settle just above 0%. So on the positive side, which is good, we don't want prices dropping from an economy standpoint because that stops things from happening altogether. So the best we want to go is right there at 0. Now, there are, of course, potential for political disruptions. In the United States, we have an election coming up here in November. And if Donald Trump wins that presidential election, he has promised to impose broad tariffs across all goods. And if that is also applied to Canada, or even worse, if he gets rid of USMCA, which is the newer version of NAFTA completely, then both exports and investment would be weaker than the forecasts, which would change things. Further, here in Canada, whenever that next federal election happens, it needs to be in the next year or so. If there were to be a new conservative government, which is looking probable, they may clamp down more sharply on immigration, which could delay the recovery in residential investment. So at the end of the day, we don't know exactly what's going to happen. We are expecting a lot of interest rate decreases regardless over the next year or so, probably about 2% on those variable rate mortgages over the coming year and a bit. And then we'll see where things continue to fall. Too many unknowns to know for sure, but that's the best we have for now. Thanks for listening, and I hope that this information is found useful for you, and I'll continue to bring you more updates here soon. Thank you.